Thank you, Senator. Though it reminds me of the question you asked in the same room as we are talking about the complexity of the tax code. Senator Lee asked one of the witnesses who was here, is with the biotech company that helped break essentially the human genome, brilliant scientists. When Senator Lee asked him about making the tax code more simple, he said, oh no, that's too complicated for me. Didn't want to really address that. It really is complex in a major way. I want to follow up Dr. Gavell's line of questioning with Senator Coates. And in your testimony and in your conversation with Senator Coates, you suggest the tax on capital gains and dividends can be safely ignored because there's such a small share of output. Are you referring output to the U.S. economy?
Well, what I mean was that given the evidence, those are savings sides. In other words, they're not at the level that can attract global capital flows. And because of the evidence that I've looked at indicates that savings is not very responsive to tax rates. In fact, it can actually go either way because of income and substitution effects. But empirically, there's not much evidence. I didn't want to talk about those partly because I think the effects they have would be extremely small and uncertain. And also, they're a lot smaller than the corporate tax. The dividends, I think I have some numbers in my paper, but they're like 0.5%. Corporate tax is not large, but still 2%. So that was the main reason, both because of the effect and the size.
I want to make the point that if you're looking at the impact of a tax, you would look at not the broad GDP, but on the tax base itself. In this case, if to make sure you're not looking at the wrong base, you would, if you're calculating the marginal after-tax return on corporate investments, you'd compare the tax on dividend capital gains to the amount of the earnings subject to the tax, rather than the broad economy. And Dr. Hassett, I made the comment at the outset that there is a great deal of interest in Washington on fundamental tax reform. My view is that while a lot of discussion is about the rate, what that number should be, our goal should be to have the most pro-growth tax policy or tax code possible, recognizing the importance of cost of capital. That's generally defined gross return on investment that's needed to cover replacement costs and taxes while providing a positive rate of return. That's what we want. Do people make an investment if they don't expect to be able to cover all the expenses related to that investment? I mean, just within the business community, within economics, do they make that investment if the rate of return is?
No, but they sometimes make mistakes and don't earn the investment that they expect to, right? But yes, this is, again, the literature that I think has converged to a broad consensus. Back in the day when we were first arguing about the user costs, that there were a lot of people who found that these variables didn't have a big effect on investment. But now there's just been hundreds of studies that find that firms really do think that way. That I think in part because business schools train folks to get their user cost formulas right now, to get the tax variables in the right place. And so absolutely, if you change the user cost, you see responsiveness that's pretty large but not enormous to changes in the user costs. It's clear that businesses are weighing the pluses and minuses with each machine purchase. If you make it easier to buy a machine by giving accelerated depreciation, it has an impact on purchases of that type of machine.
Does the economic literature you're referencing, does it tend to be constant over time when referring to the after-tax rate of return on capital?
Is the after-tax rate of return on capital constant over time? I think that it's not clearly so. I have to get back to you on this one to look at it. But yeah, I think that around changes, big tax changes, then you can see it takes a while for the capital stock to adjust. And so I'd have to get back to you on that.
Okay, great. Thank you. Representative Mulvaney?
Very briefly, just a couple follow-ups.